Inventory reserves. It sounds like one of those dry accounting terms that only the number crunchers care about, right? But let me tell you, understanding inventory reserves is crucial for any business, big or small. It's not just about keeping the books neat, it's about making sure your financial health is as robust as it can be. So, let's dive into it together. First off, what exactly are inventory reserves? You might have heard them called inventory allowances or write-downs. They're essentially a way for businesses to account for the decrease in inventory value over time. Think of them as a safety net, cushioning the blow when things don't go as planned. Now, let's break down the common types of inventory reserves. The first one on the list is the obsolescence reserve. This is set up to account for inventory that's become outdated. Picture this. You're a computer retailer, and you've got a stock of laptops that were the hottest gadgets 2 years ago. Fast forward to today, and they're practically dinosaurs, overshadowed by sleek, new models. Those older laptops? They're not just sitting pretty, they're losing value. That's where the obsolescence reserve comes into play. It helps you prepare for the inevitable write-down when you have to mark those laptops down to get them out the door. Next up is the excess inventory reserve. This one's all about having too much of a good thing. Imagine you're a clothing retailer, and you've overestimated the demand for a trendy seasonal item. You've got racks and racks of those t-shirts, but they're not flying off the shelves like you thought they would. You know you'll have to discount them to move them, and that's where the excess inventory reserve helps you out. It's like a financial cushion for when you realize that your inventory levels are higher than your sales forecast can support. Then there's the shrinkage reserve. This is a bit of a catch-all for losses that happen due to theft, damage, or even just clerical errors. Let's say you run a grocery store. You've got a whole section of perishables, and some of them spoil before they even get a chance to be sold. Or maybe some items go missing. Who hasn't heard the stories of shoplifting? A shrinkage reserve allows you to account for those losses, so you're not blindsided when it comes time to close the books. And we can't forget about the lower of cost or market, or LCM, reserve. This one's crucial when the market value of your inventory dips below its recorded cost. Imagine you're a furniture manufacturer with a line of wooden chairs. You've had them in stock for a while, but consumer preferences have shifted, and suddenly those chairs aren't as desirable. If the market value drops below what you paid for them, you need to establish an LCM reserve to reflect that loss accurately. It's all about ensuring your financial statements give a realistic picture of your inventory. Now, let's get a bit more practical. How do you know when to set up these reserves? Let's start with the obsolescence reserve. Say you're producing electronic goods and have components gathering dust in your warehouse for over 2 years. You need to assess whether those parts are still usable or if they've become obsolete. A thorough inventory inspection, checking market demand, and evaluating the condition of those components are key steps. If you determine that a portion is no longer sellable, you'll need to calculate your obsolescence reserve. You can use a couple of methods here. The percentage of sales method estimates how much of your sales will be lost due to obsolescence. If you think 5% of your annual sales revenue of $1 million will go to waste, that's a $50,000 reserve you'll need to set aside. The aging method looks at how long your inventory has been sitting around. If you estimate that 10% of your $500,000 inventory will become obsolete, you're looking at another $50,000 reserve. Next, let's tackle the excess inventory reserve. If you're a clothing producer with t-shirts that have been in stock for over 6 months, it's time to assess whether they're still sellable. You'll want to analyze market demand and see if those shirts are likely to move. If you estimate that 5% of your $1,000 and $1,000 in sales will be lost, that's another $50,000 reserve. Or, if you think 10% of your $500,000 inventory is excess, you're back to that $50,000 figure again. Now, what about the shrinkage reserve? This one can be a bit tricky. Let's say you're running a business with a cost of goods sold of $500,000 and net sales of $1,000. If you find discrepancies in your inventory levels, you can calculate your shrinkage reserve using the formula cost of goods sold, net sales, x inventory. If your average inventory level is $100,000, that gives you a $25,000 reserve. It's a way to cushion the blow from those unexpected losses. Finally, let's talk about the LCM reserve. If you're holding onto a batch of wooden chairs with a cost of $50,000, but the market value has plummeted to $40,000, you need to account for that difference. Your LCM reserve would be $10,000, reflecting the decline in value. So, how do you keep track of all this? Here are some best practices. First, conduct regular inventory counts. This is your first line of defense against discrepancies. Regularly checking your stock can help you catch issues before they spiral out of control. Next, keep an eye on market trends. If you notice a shift in consumer preferences or a decline in demand, it might be time to reassess your inventory reserves. Historical data is your friend here. It can reveal patterns that help you anticipate future needs. Analyzing production and sales forecasts is also critical. If you're producing more than you're selling, that excess inventory reserve is going to come into play. Consulting with accounting professionals can help ensure you're following best practices and staying compliant with accounting standards. And lastly, review and adjust your reserves regularly. Just because you set them once doesn't mean they're set in stone. As your inventory levels and market conditions change, so should your reserves. So there you have it, a deep dive into inventory reserves. It may seem like a lot of work, but trust me, keeping a close eye on your inventory reserves can save you from significant financial losses down the road. By understanding the types of reserves, knowing when to set them up, and implementing best practices, you can ensure your business stays financially healthy and ready for whatever comes next. Remember, it's all about being proactive rather than reactive. So, take control of your inventory reserves and watch your business thrive.